The organization that controls how much money exists in America is not owned by the government, and who actually owns it will change how you see everything. If you walk up to 10 random Americans and ask them who owns the Federal Reserve, 9 of them will say the government. They're wrong. The Federal Reserve, the institution that decides interest rates, prints money, and controls the entire economic heartbeat of the United States, isn't a government agency. It's privately owned. And the banks that own it are the same banks it's supposed to regulate. Let that sink in for a second. To understand how insane this really is, we need to go back to 1910. A secret meeting happened on Jekyll Island, Georgia. No reporters, no government officials, just 7 men. These weren't politicians, they were bankers, the most powerful bankers in America. JPMorgan's team, representatives from the Rockefellers, a Rothschild agent, people who controlled more wealth than most countries. They met in total secrecy, using fake names, pretending to be on a duck hunting trip. Why? Because they were designing the blueprint for the Federal Reserve System. 3 years later, in 1913, Congress passed the Federal Reserve Act. It was sold to the American people as a way to stabilize the economy and prevent bank panics. What they didn't tell you? The structure they created gave private banks ownership and influence over the very system that would control the nation's money supply. Here's how it actually works. The Federal Reserve System has 12 regional banks across the country: New York, Chicago, San Francisco, and 9 others. Each one of these banks is technically a private corporation, not owned by taxpayers, not owned by the Treasury Department, owned by member banks. If you're a nationally chartered bank in the U.S., you're required by law to buy stock in your regional Federal Reserve Bank. That means JPMorgan Chase, Bank of America, Citigroup, Wells Fargo, they all own shares in the Fed. Now, you might think, okay, but they don't control it, right? Well, not exactly. Member banks don't vote on monetary policy, but they do elect 6 out of 9 board members at each regional Fed bank. And those regional banks have enormous influence, especially the New York Fed, which conducts most of the Fed's market operations. So while the Fed isn't a private company in the traditional sense, it's not fully government either. It's a hybrid, a public-private partnership designed to operate with independence from political pressure. But here's the kicker. Independence from government doesn't mean independence from banking interests. Let's break this down step by step because it's deliberately complicated. At the top, you have the Board of Governors, 7 people appointed by the President, confirmed by the Senate. This part is technically a federal agency. Below that, you have the 12 regional Federal Reserve Banks. These are structured as private corporations. They issue stock, they pay dividends, they have shareholders. And who are the shareholders? The biggest banks in America. Now, the Fed will tell you these aren't normal stocks. You can't sell them on the open market. The dividend is capped at 6%, and any profits beyond that go back to the U.S. Treasury. All true. But here's what they won't emphasize. The same banks that own pieces of the Fed are also the ones borrowing from it, being regulated by it, and benefiting from its policies. When the Fed lowered interest rates to 0 during the 2008 financial crisis, who benefited most? The banks. When the Fed printed trillions of dollars during the pandemic through quantitative easing, who got first access to that money? The banks. It's not a conspiracy, it's structure. And that structure creates a conflict of interest most Americans don't even know exists. So why does this matter to you? Because every financial decision in your life is shaped by what the Federal Reserve does. Your mortgage rate, the Fed influences that. Your credit card interest, tied to Fed policy. Your savings account that earns almost nothing, that's because the Fed kept rates near 0 for over a decade. Inflation, eating away at your paycheck, the Fed controls the money supply. Here's the emotional gut punch. When the 2008 crisis hit, millions of Americans lost their homes, families were destroyed, retirement accounts were cut in half. And while everyday people suffered, the Fed bailed out the very banks that caused the crisis. Banks that, by the way, own shares in the Federal Reserve. It wasn't the government bailing out the banks. It was a system designed by banks, for banks, saving itself. And the American people? They got the bill. The Fed created trillions of dollars out of thin air, handed it to financial institutions, and the long-term cost was passed on to you in the form of inflation and debt. Zoom out for a second. This isn't just about the US. Central banks around the world operate with similar structures. The Bank of England, the European Central Bank, the Bank of Japan, they all have varying degrees of independence from their governments, and they all work closely with private financial institutions. Why? Because the modern global economy runs on debt and credit, and managing that system requires coordination between governments and banks. But here's the uncomfortable truth. When you build a system where the people who benefit from money creation also have influence over money creation, you create a built-in advantage for the financial class. It's not left or right. It's not Democrat or Republican. It's about who sits closest to the money printer. And for over 100 years, that's been the banks. The wealth gap in America didn't appear by accident. Policies that favor asset holders over wage earners aren't coincidences. They're features of a financial system where those who own assets, stocks, real estate, businesses, benefit most when the Fed expands the money supply. Everyone else just deals with higher prices. So here's the takeaway. The Federal Reserve is not your enemy, but it's not exactly your friend either. It's a powerful institution designed to serve two masters, public stability and private banking interests. And when those interests conflict, history shows us which one usually wins. You don't have to believe in shadowy cabals or secret conspiracies to see the truth. Just follow the structure, follow the money, follow the ownership. The next time someone tells you the government controls the economy, you'll know better. The Fed controls the economy, and the Fed is owned by the banks. Now you know who really pulls the strings.